What's going on today, YouTube? Hope you guys all had a great day. If you're new to my channel, I make daily stock market videos teaching you guys stuff I wish I knew when I first started. Trying to cut down you guys' learning curve a little bit. I figured today I'm going to cover what shorting is. If you hear the term shorting stocks, I'm going to explain to you what it is, your potential risks of it, and why people do it. If you like this kind of content, leave a like on the video, comment below you got any questions, share it to someone else that could use it, and subscribe to my channel. Hit that notification bell so you know when I'm coming out with new videos. So let's jump right into it. Shorting stocks. Okay. Shorting a stock is when you are, instead of buying it and expecting it to go up, and that's how you make your money, you're betting on this stock to go down. So where you make your money, say here, you decide to short it. You're going to make 47% if you stay in that long. You make money when the stock goes down instead of the reverse when you make money when the stock goes up. When you do this, you have to borrow shares. So here, you're borrowing shares from your shareholder, you short it, and you buy them back when you want to get out of the position. So when you're on your platform, the market's open, you would go like minus 100 shares. So your shareholder, and a lot of times it's hard to find shares to short because sometimes a lot of brokerages won't let you borrow shares, and so you're betting on the stock to go down. You borrow the shares and you buy them back here. So you hit sell. So you are borrowing 100 shares. You would go minus 100, and when you want to get out of your position, you would hit plus 100. You'd buy them back. Okay, now that you know what it is, a lot of the risks that are involved. Your potential for risk is unlimited. Why I say that's unlimited? When you're investing, say you're investing in this company, you're just buying shares. Say you want to buy down here, you have hope that this stock's going to go up. Say you buy $1,000 worth, and it goes up. Then you make money. You would have made about 500%, 550. Now, you have $1,000 invested. Say that instead of this company going up, they went bankrupt, it went down to zero. The most you can lose is what you have invested, which would be $1,000 in this scenario. When you were shorting a stock, say you decide to short here because you saw this red day, your potential for loss is unlimited because you have to buy the shares back that you borrowed. So now, in this case, say you want to get out of your position after it went from here to here, you have to buy back how many ever shares you shorted at that $5 price level. Say this thing keeps on going up and up and up, goes up to $20, $100, $1,000. You have to buy those back. So since there is no limit on how far a stock can go up, your potential for loss is unlimited. Who knows what you could be buying the shares back at? That's why it's so risky, and you could lose an unlimited amount. There is no, like when you invest, you can lose. You have $1,000 invested, you can lose $1,000. When you are shorting, you have $1,000 invested, you could end up owing tens of thousands of dollars if it would go up like 10 times. So that is why shorting is risky in my eyes, in my opinion. A lot of day traders, and I'm just telling you what they do. This is not advice to do at all. But a lot of the people that short stocks out there, they'll wait for the first red day, and that is when they will go into a short position. But as you can see, just in this chart, that doesn't always work. Say they did it here. They already saw this stock go up 170 some percent, and they had this first red day. So they decided, okay, it's up 190%, I'm just going to short it. Well, guess what? In this case, they were wrong, and it kept on going up. So you short at the end of the day, you're paying back 1.5 times what you already put in if you got out up here. If you got out in here, you'd pretty much break even. But you just don't know. That's why it's risky. Like, I guarantee a lot of these people saw this first red day right here. And then this huge jump was a result of a short squeeze. Since it didn't keep going down like they expected, everyone has to buy back their shares that were short in that stock. So when they buy back the shares, the stock price keeps on going up and up and up. Every trader out there has a limit, and when they're at their, say, risk-reward limit, they got to get out. So to get out, they got to buy the shares, and that's most likely why this big spike happened. You'll see a lot of short squeezes after it has a first red day, then it has a green day, and then keeps on going. Short squeeze. So right here, that first red day rule, it's an outlier. Like it didn't work, and a lot of people probably lost a lot of money. Now, if it worked here, first red day worked here. But another thing I want to tell you, like make you guys realize, you saw this first red day, so you got into a short position. As you can see, that stock opened up here the next day. That's already a 3.6% loss on your position. So if you saw it opening higher than when it closed, you might have panicked and got out really quick right there. And sometimes it's hard. I mean, it's hard to hold on to these things. You just don't know what's going to happen. So if you're already down 3.6 and you cut losses at 2%, you're going to miss out on that portion of the trade too. So that's it for the video, guys. Just wanted to explain a very brief explanation of what shorting was for if you don't know, and how risky it can be if you're not careful. So if you like the video, you like this kind of content, subscribe to my channel, leave a like on the video below. It lets me know you guys are benefiting from this information. It is actually helping you out. Comment and share it to someone else. And I will see you guys tomorrow.